Welcome to the deep dive. Today we're looking closely at Roku. You've probably seen the name around, maybe noticed its stock price doing a bit of a dance lately.
Yeah, it's been quite volatile.
Exactly. We're working from a recent analysis by the Motley Fool, published May 7th, 2025, and our mission today is pretty simple. Let's try to really understand what's driving Roku's financial picture and whether the stock might be an interesting prospect right now.
Right, cutting through some of that market noise.
Yeah, we want to get past the day-to-day fluctuations and look at the core factors.
And it's interesting because, like you said, the recent stock chart tells one story, maybe a bit gloomy.
Down quite a bit, yeah.
But when you dig into the actual business performance, there are, well, some potentially more positive signals emerging.
Okay, let's start with that stock performance then. The Motley Fool piece points out that while the broader market's been doing reasonably well, Roku's stock is actually down significantly, something like 45% over the last 3 years.
That's right. And that includes that big correction after the huge surge it had during the pandemic lockdowns, when everyone was streaming.
Right, that initial boom had to cool off eventually.
It did. But what's perhaps more puzzling is the dip after their most recent earnings report. They actually beat the analyst estimates.
They did.
Yeah, beat estimates, reaffirmed their guidance for the future, but the stock still fell, dropped about 8.5%.
Okay, hold on. Beat expectations, said they're on track. Why the drop then? That doesn't immediately make sense.
Well, the article suggests the market reaction boiled down to their guidance, their forecast, being just slightly under what analysts were hoping for, like the consensus estimate.
Okay.
It just shows how sensitive Wall Street can be to those forward-looking numbers, even small misses against expectations.
Right, so the market's laser focused on predicting the future there. But, okay, let's put that immediate reaction aside for a moment. What about the underlying business? What are Roku's actual strengths right now?
Well, the big one, according to the article, is their market position. They are still the #1 streaming platform in the U.S., Canada, and Mexico. That's a huge existing audience.
Can't argue with that scale.
Exactly.
Right.
And their Q1 results for 2025, the ones we were just talking about, showed growth continuing. Revenue was up 16% to just over $1 billion, $1.02 billion.
Okay.
And maybe even more importantly, total streaming hours on the platform jumped 17%. That hit 35.8 billion hours.
Wow, 35.8 billion. So people are definitely still using Roku devices a lot.
A lot. It shows engagement is still really strong, and they're still finding ways to grow the top line, the revenue.
Okay, engagement's strong, revenue's growing. But the elephant in the room is always profitability, isn't it? What does the article say about that, their history and where they're headed?
It tackles that directly. They actually were profitable, during the peak pandemic period.
Yep.
Makes sense. Everyone was home. But then they fell into losses in 2022. The Motley Fool analysis suggests this was mostly because they kind of overspent, expanded too quickly to meet that temporary demand surge, hired a lot, built out infrastructure.
And then got stuck with those higher costs when things normalized a bit.
Pretty much, yeah. That seems to be the narrative. It became a drag on the bottom line.
Okay, so that explains the losses. What's the plan now? How do they get back into the black consistently?
This is really the key point the article drives home. Roku has publicly set a target: achieve GAAP operating profit in 2026.
2026, okay, that's a clear goal.
It is. It signals a major strategic focus on getting profitable and staying profitable. And importantly, the latest quarterly numbers shows some, actual evidence they're moving that way.
How so? What are the signs?
Well, their operating loss got smaller. It went from $72 million in the same quarter last year down to $57.7 million this quarter.
Okay, narrowing the gap.
Exactly. And their GAAP loss per share also improved. It was 35 cents last year, now it's down to 19.10 cents. So while they're not profitable yet, the losses are shrinking. That's a crucial first step.
Right, they're stopping the bleeding, so to speak. Now, the article also mentioned diversification. They're trying not to put all their eggs in one basket.
Yes, that's a really important part of their strategy now. They were pretty heavily reliant on ad revenue, especially from, media and entertainment companies. M&E.
Movie studios, TV networks, that kind of thing.
Yeah. And that specific sector pulled back its spending a bit in 2022, which hurt Roku. So they've been pushing hard to grow other revenue streams, make the business more resilient.
Okay, like what? What other areas are growing for them?
Well, one area is streaming subscriptions. That provides a more steady, predictable income. But the really big story seems to be the Roku channel.
Their own channel within the platform.
Exactly. It's apparently now the #2 app on the entire Roku platform in the U.S., just based on how much people watch it.
Number 2.
Yeah. And get this. Streaming hours just on the Roku channel itself were up 84% compared to the previous year.
84%? That's huge growth. What's driving that?
It seems to be a mix of things. They're definitely adding more content. The article mentions a new deal with Major League Baseball, for instance. They're getting an exclusive Sunday game each week.
Okay, live sports. That's a big draw.
Definitely. And they're also doing more Roku originals, their own shows and movies, and bringing in big-name sponsors for those, like Airbnb and Miller Lite. It shows they're serious about making it a real destination, not just a pass-through.
So building out their own content ecosystem, interesting shift. And then there was that acquisition, Friendly TV. What was that about?
Right. They bought Friendly TV, paid $185 million for it. Friendly is a subscription service, but it offers live TV channels, over 50 of them.
Like traditional cable channels.
Yeah, I think Hallmark Channel, A&E, History Channel, those kinds of networks.
That feels a bit different. Why buy into that more traditional linear TV model?
Good question. The article frames it as expanding Roku's footprint in 2 areas. One is that linear TV space, but the other is something called FAST channels.
Fact.
Yeah, F-A-S-T, stands for Free Ad-Supported Streaming Television. Basically, channels that look and feel like traditional TV with schedules and ad breaks, but delivered online for free.
Ah, okay. Like Pluto TV or Tubi channels.
Exactly like those. And Roku CEO Anthony Wood apparently sees FAST as a really big growth area. So buying Friendly gives them instant scale there and also caters to people who still like that curated, lean-back channel experience.
Got it. Covers more bases, appeals to different viewing habits. Makes sense. Okay, switching gears back to advertising for a second. Are they doing anything to make their ad platform itself better or easier to use?
They are. They're trying to attract more advertisers, especially smaller ones. The article highlights a tool they developed called Spaceback.
Spaceback, what does it do?
It basically lets businesses, particularly small and medium-sized ones, easily repurpose their existing social media content, videos, images they already have, into ads suitable for connected TV for the Roku platform.
Oh, that's clever. Lowers the barrier for entry, right? Don't need a huge ad production budget.
Precisely. Makes it much easier for smaller companies to get onto TV screens via Roku. And apparently, it's effective.
Did the article give any examples?
It did. It mentioned one advertiser who used Spaceback and apparently lowered their cost per website visit by 76% compared to other non-Roku TV ads they were running.
76%. That's a number that'll get advertisers' attention.
You'd think so. It definitely suggests Roku's platform can offer real value and efficiency for ad spending.
Okay, so let's pull all these threads together. We have the stock volatility, sure. But underneath, we've got this huge user base that's still highly engaged.
Right.
Strong growth in their own Roku channel, diversification with subscriptions, and now FAST channels through Friendly TV.
And improvements to their ad platform making more attractive. Yeah.
So what's the overall outlook? What's the potential upside here, according to the analysis?
Well, the Motley Fool piece kind of sums up these positive trends as emerging tailwinds. They point to Roku showing better scalability, meaning revenues growing faster than costs, which helps margins.
Improving profitability potential.
Exactly. They seem to be getting a better handle on their operating costs, too. Plus, that strong growth in the Roku channel and FAST, boosted by Friendly TV. And finally, just being an attractive place for advertisers because they can reach specific audiences with video.
So despite the stock taking a hit recently, the underlying business might be setting up for a comeback.
That's certainly the argument presented. Now, they do add a note of caution. The overall economy, the macro environment, could still affect how quickly they reach that profitability goal.
Sure, external factors always play a role.
Always. But the analysis suggests that if Roku keeps growing revenue like this, and if they keep improving those profit margins, especially beyond that 2026 target, then the stock could have significant room to run. They talk about potentially doubling or even tripling from its current market cap, which is around $10 billion now.
Doubling or tripling. Okay, that's substantial potential. But it hinges on that continued growth and margin expansion.
Very much so. Driven by getting more users, keeping them engaged, and capitalizing on the growth of ad-supported streaming generally.
Okay, so to wrap up the main insight here, despite some stock market turbulence, Roku seems to have a clear strategic plan aimed at hitting consistent profitability by 2026. Key drivers appear to be ongoing revenue growth, smart diversification efforts like the Roku channel and Friendly TV, and making their ad platform more powerful.
That sums it up well. The short-term stock moves are one thing, but the underlying business strategy and the trends highlighted in this analysis, they paint a potentially more optimistic picture for the longer term.
Right. So here's something for you to think about after this deep dive. Considering Roku's position in this constantly shifting streaming world and these moves they're making, like with the Roku channel and Fast T, what other big factors out there, maybe trends we haven't even seen fully emerge yet, could really change their journey towards sustained profit? What could turbocharge it? Or maybe throw a major wrench in the works? Something to mull over. Thanks for joining us.